IBM just suffered one of the most shocking business disasters of 2026. And the strangest part is that the company didn't collapse. On July 14th, 2026, IBM's stock plunged more than 25% in a single day, wiping roughly $67 billion from its market value. It was the biggest one-day percentage drop in IBM's 115-year history. But this wasn't a story about a company running out of money. IBM was still generating billions in revenue and billions in cash. So how did one of the world's most famous technology companies suddenly lose tens of billions in value? The answer reveals something much more dangerous than a bad quarter. For years, IBM had been rebuilding itself around software, cloud computing, artificial intelligence, and high-value enterprise services. And for a while, the strategy seemed to be working. Then came the second quarter of 2026. IBM reported preliminary revenue of $17.2 billion, up 1% from the previous year. Software revenue even grew 5%. But there was a problem hiding underneath those numbers. IBM's infrastructure revenue fell 7%. And the company had expected better. CEO Arvind Krishna admitted that the quarter had gone worse than expected. The company had expected major deals to close. They didn't. Customers suddenly changed where they were spending their money. Instead of buying the infrastructure IBM expected, many rushed to secure servers, storage, and memory because they feared shortages and higher prices. At the same time, cybersecurity problems were distracting customers. The result was brutal. IBM had planned for uncertainty, but not this particular kind of uncertainty. And that is where the real lesson begins. The disaster wasn't simply that IBM made a bad prediction. It was that several reasonable assumptions failed at the same time. IBM had a strong strategy. It had powerful technology. It had major customers. But markets don't reward companies for having a good plan. They reward companies that can adapt when reality suddenly changes. And investors reacted immediately. The stock's collapse showed just how quickly confidence can disappear when expectations break. But here's the twist. IBM wasn't suddenly a terrible company. Its second quarter revenue still grew, software remained strong, and several parts of the business performed well. IBM later said it remained confident in its overall strategy while updating its expectations for the year. So the biggest lesson isn't don't take risks. It's almost the opposite. Take risks, but never become emotionally attached to your forecast. Watch what customers actually do. Build room for surprises. And most importantly, remember that a business can be financially healthy and still have a massive expectation problem. IBM didn't lose $67 billion because its entire business disappeared overnight. It lost that much because investors suddenly believed the future would be different from what they had expected. And that may be the most dangerous business disaster of all. If you enjoyed this story, like the video and subscribe for more business stories. And tell me in the comments, was IBM's 2026 crash a temporary mistake or a warning of something much bigger?